Hi everybody, it's Mark here at Treasury, and unfortunately Tesla closed in the red again today, and the closing price was $232.96, which was a decrease of $6.80 per share, or a decline of 2.84% since yesterday's close. Now, as you probably know, Tesla hasn't been really following the market's performance and actually has been underperforming even the likes of a tech-heavy NASDAQ. So before we take a look at the Tesla chart in the news, let's just go ahead and see a comparison of how Tesla's performing versus the QQQ, which is an ETF that tracks the NASDAQ performance. You can see how the QQQs are kind of consolidating, and whereas Tesla has been selling off for many days, always making lower lows every single time and lower highs as well. So the chart continues to be very desperately bad. And you can also notice, if I go back to the Tesla chart, the share price after hours has dropped a little bit over $1, whereas the Nasdaq is actually up a little bit in the after hours. And we can do a quick look at the S&P 500, where it is slightly up after hours as well. Now, we're saying that Tesla's underperforming the Nasdaq, but is it every quote-unquote like AI name that is underperforming? Well, not necessarily, because Nvidia has been finding some support. It's got some pretty big bounces. It maintained itself in the green today, whereas Tesla was very red. And you can see these jaws opening up, where from the doldrums of spring into the AI boom of early summer, Tesla has been slightly tracking Nvidia. Even through Nvidia's strong performance in its quarterly earnings report that was done in May, Tesla has been tracking pretty well and taking advantage of the AI euphoria. But ever since the 19th of July, which was Tesla's quarter two earnings report, Tesla has not really done that well compared to Nvidia. Even though Nvidia did sell off, it kind of maintained more of its share price, and especially in the past couple of days has done very well. And this is the realities that Tesla's being hit from kind of two different sides, where some not so AI names are being sold off, and the only true AI name in the business, which is going to be Nvidia, continues to find interest and buyers. And so you might hear from really bullish Tesla types that Tesla is very much an AI company and is pursuing much more compute, but the reality is the only real name is Nvidia, which happens to be selling the chips that power people's server farms, and there's no real monetization of AI outside the hardware, basically the business to business aspect of producing semiconductor chips, and all of the peripherals in regards to that, the networking hardware, the actual racks and things. So you can see some really strong performance recently from the likes of SMCI, which is super micro, and Tesla is not being lumped into that core category of one of the true AI names. So I think we just need to kind of understand that Tesla is, as the market perceives it, definitely 100% an automobile stock. And you can kind of see that here in the comparison to GM, Ford, Rivian, and Tesla, where all of these tickers are actually selling off kind of commiserately. There's no outperformance when it comes to one auto manufacturer to another, and also there is lower lows, lower highs being made all across the board. So if you're holding the stock, just be aware that your stock is being considered a simple automobile manufacturer, regardless of it being a tech company, be it a startup like Rivian, be it legacy OEM. You're just basically that. So what was the big news for today? It was that China's central bank unexpectedly cut rates to support sputtering economy, says Reuters. And the cut was marginal. It was a 15 basis point percent cut from 2.65 to 2.5%. And the article goes on to say China's central bank unexpectedly cut key policy rates for the second time in 3 months on Tuesday, in a fresh sign that authorities are ramping up monetary easing efforts to boost a sputtering economic recovery. I mean, there's no economic recovery. They are completely in deflation. The article mentions that they're risking deflation, but we know based off their recent PPI and CPI reports that this country is 100% in deflation. Now, the markets did sell off because of this when this happened, and this is one of the reasons why, even though as Tesla shareholders or shareholders, if you're holding shares of any company, you would love to see rates cut in America as well, but the same reaction would happen if the Federal Reserve was to unexpectedly cut rates in their September meeting, just like if the China central bank was to cut their rates, their market would have sold off, and it did. And you can see it here. We'll switch back to the charts real quick, and you can see how the Hang Seng Index, for example, gapped down pretty strongly, but in kind of a bullish context, they didn't make a new low yet. They kind of found support on the diagonal trend line, and if the rate cut is going to work in the way that you think it would, which would to get people to spend money, get people to lend money, maybe you see this be the base and this be the bottoming process for the short term on the Chinese market, and maybe some bullishness can happen tonight. We're going to see maybe in a couple hours, and you can watch this in your trading view, or just look up the Hang Seng Index or the CSI Index to see how the Chinese stocks are performing. I think the American markets would be pretty sympathetic in that move if they were to go up. If it was to go down further, because even if the rate cuts are beneficial to the economy, it might be a little bit too late, and it might not be really enough to get people to start moving money around and buying and lending. So we'll watch that later. There's some other news that came out too when it comes to more Tesla related news, and that is going to be here's a tweet from Sawyer Merritt talking about how there are 2 new models available for the higher end Tesla cars. So the standard range is now available for the Model S and Model X cars. These are software limited versions of those cars that reduce their range, and currently it doesn't seem like there's no actual hardware changes to enable this new model, and there's currently not a plan to offer firmware upgrades to unlock that extra performance in the future. So that's kind of weird. This could be kind of like a battery as a service type of business for Tesla, where they are moving cars that they might have more of at a lesser cost in the future. If people get really attached to their Tesla, can unlock those extra features or the extra performance by paying a couple thousands of dollars to get more range, to get more power, what have you. We seem to get more power from other models, so that's not really surprising. But this could be the start of something that could be a whole new way to increase volume. But at the same time, I think the market perceives this in a different way, where we've seen the production numbers for the S and X. We've seen over the past 2 quarters that the production has, if you average it out for the past 2 quarters, that the production definitely is much more than what they're delivering. And I assume inventory is being built up over the past couple months. And even though there was kind of a lag in deliveries due to where the SX are being made and where they actually have more demand, which is overseas. So there is a big kind of a logistics issue that's kind of getting those cars delivered quicker and having those delivery numbers reflect better in the quarterly reports. I think we might see in the next quarterly report, when it comes to sales, that the S and X are kind of still building inventory. And this move is actually not a move of like some ingenious way to sell more cars, but this is a sign that demand for the S and X is still lagging, and they are just kind of out of the affordability of most people in this world. And that's mostly due to because of higher interest rates on auto loans. So if you're not buying in cash, you're kind of subjecting yourself to a payment that, if not but 1.5 years ago, you would have been saving hundreds of dollars per month in comparison. So here is just some quick stats. The Model S standard range is coming in at just over $78,000, 320 miles in range. Still maintains a pretty good 0 to 60. Model X standard range is very low at 269 miles of range at $88,500. But I say very low. I think the average consumer, and I think Tesla knows this from their data, isn't actually using this charge, this ability to travel 270 miles in a charge. I think, the average person is just doing what average people do on a day. Maybe they're taking their kids to school or going to work, getting a couple of groceries at the store, coming back home, plugging their car into their wall-mounted charger, and they probably use 50% of that range in a day. So, a lot of people are criticizing, this lower range, no one's going to buy this is not practical. But it seems like in the future, I think you're going to see range come in as more of the EV audience and potential customers are educated, and the fact of their driving habits don't really require you to be able to travel 400 or 500 miles on a single charge, because not everyone is doing long distance road trips every single day. And in fact, I don't know anyone who does that in real life. No, I don't know anyone who loves just to drive across the country, and maybe it's because of the type of community and culture I'm in, drive across the country in a Tesla and go sightseeing. That's just not what that might be what the vocal minority on X or Twitter or YouTube are doing, or people who want to push the performance of the cars they're buying, especially their Teslas. It's not what every normal, average, ordinary American is wanting and needing their car to do. So that might be a controversial opinion, but this is it's cool that there's a cheaper X's and S's, but this is obviously just a sign of lower demand. And let's go over to the economic calendar, which is going to show a lot of the economic data drops that happened today. U.S. retail sales came in much stronger, and that was also kind of counteracted with Empire State Manufacturing Survey, which was negative 19, coming very, very low in comparison to the expected 1.4. So when the retail numbers came out at 8:30 a.m., I'll show you the chart real quick for that. Let's go over to the chart, and we'll kind of center our focus on the yields of treasuries. And you can see here this big spike that got over actually 4.25%, which would be a pretty big deal on the 10-year treasury, and if you saw the yield come down from that point. But on the initial news of the U.S. retail sales coming in really, really, really hot, everyone had this kind of fear in that brief moment that this kind of number would possibly modify the Fed funds future rate expectations to a possible another hike due to a consumer, quote unquote, being strong. But you saw that quickly revert and yields actually drop and recover slightly throughout the day. So the retail numbers weren't as consequential as maybe the sign that manufacturing in this country is dropping, meaning that demand for goods is actually being destroyed, and in turn really putting the screws and vice on our manufacturers all over this country. And I think we've heard from the recent Dallas survey that companies and factories are in a really tough spot right now, with interest rates destroying their consumer base, destroying their ability to do business. And we're seeing a lot of bankruptcies happen this year in comparison to many, many other years. This is looking to be one of the worst years for bankruptcies. And I guess it's not all too surprising, but how are we kind of reconciling that fact with the idea that we're not going to be in a recession anytime soon? A lot of people think that maybe due to the really, really tight labor market, you can kind of skirt any of those potential black swan events, and maybe that's good for the economy as far as like the normal average everyday person maintaining their lifestyle and maintaining their jobs and not having to go through what we all probably remember from 2008, the great financial crisis. We don't really want anything like that happening to normal people in this time, especially for people who did really nothing wrong, where all of these economic effects that we've been dealing with have really, I think you can easily say this was a policy thing and not some type of consumer mentality. This wasn't a bubble that was initiated by some housing euphoria, where housing prices are really just is subject to supply and demand, and there's just no supply even to this point. And it would be like you would look at how well how well the home builder stocks are doing in comparison to what your kind of conception of how a this economic environment with high interest rates would destroy demand to housing, but that is not shown in any weakness when it comes to the likes of the DR Hortons and Lennar stocks. I mean, to the point where Warren Buffett is selling, Chevron and selling GM and actually buying and increasing positions in these home builder stocks as of last quarter, even when they've already run up a great deal or making all-time highs. He's actually adding to his home builder stocks because that's the reality. Like if they're able to keep their value and increase it to all-time highs during some of the biggest drawdowns in tech stocks of last year, think about when rates come down. These home builders are going to be able to move homes at a crazy clip, and with input costs like the commodities that really affected the housing pricing 1 to 2 years ago. Timber is not expensive at all comparatively to what it was at the height of this housing euphoria. So I think it's a really good move on his part to really load up on home builder stocks, and maybe something other people can think about as well. That's not financial advice, obviously, because we're also seeing other sectors of the retail market not really doing very good. REITs are hurting, and especially commercial properties are really hurting, and that could be a problem for the next many years to come. But residential homes, they're always going to be in demand, and they're still in demand even at these 7 to 8% mortgage rates for people with excellent credit. That's really, really surprising. And we can see that, and we'll switch back to the browser real quick, and we'll go over to the Fed funds future rate. So even with the really hot retail number, we're actually seeing 90% instead of the 88.5% likelihood that there won't be a rate increase in September. So that's maybe a good thing, and that can, if we can get a little bit more better data over the next month, we can maybe find a bottom in this correction in the market. So looking back at the charts, let's look at Tesla again. And this is Tesla on the daily time frame, and you can see how we're definitely below the gap after it was closed yesterday. We're definitely closing below it. And here's the volume profile on the right hand side, and we're kind of in that vacuum of profile where there's not much action and interest in the area we're currently in. We're actually floating kind of right in the middle of this valley, where it suggests that there is much more interest below the next gap. Closing the next gap would mean closing around $220 a share, which would be coinciding with the 200 EMA in this blue line right here. So there's some confluence right here. This is kind of why we drew the line, kind of turning at this point. These green lines are what we drew in previous videos, kind of trying to anticipate what price action would look like as we're falling out of this descending wedge. Let me delete this and show you kind of what we've been looking at over the course of the last couple of weeks. This descending wedge, this falling wedge pattern has pretty much been broken out of in a very bearish way, in bearish context, where some people were thinking this would be a kind of a bullish reversal, and it is in certain respects. I mean, we've shown some examples yesterday about how that could work if it was to break up, and we're not really necessarily in a terrible spot in relation to this descending wedge, but it really, tomorrow you really need to see what we'll talk about in a second, which is kind of a test and maybe retaking that trend line. But yes, so we're in the valley of the volume profile. You don't see interest coming until maybe another drop of about 8% perhaps. Like, let's just do, if you were just to look at this volume profile, if you look at the gap below us, if you look at the last moving average that might give us support, you could see somewhere in the range of 5%, and the beginning of the volume profile is down here. Let's say 5% to 10%. So this kind of area is anywhere below 220 over until let's say 209. That's kind of where it's possible, and if it doesn't turn now, and if it falls very quickly, that you might be able to find some support. It kind of lines up with the peaks from the spring consolidation. And let's go to a smaller time frame, and we can see how our guess of how pricing action is going to work. Let me turn off the these two indicators that we were looking at earlier. So we were thinking that if it was to come back out of this this wedge, that it would close below, and maybe it would need to come back and test the lower side of this horizontal trend line, which would be this kind of green curve up and drop down. If it's really bearish tomorrow, let's say the Chinese market kind of boosts sentiment a little bit. Maybe if the Chinese market does go green, you can maybe see Tesla, gap up a little bit tomorrow. Maybe it sees like 235. The question is, does it come back down during the next couple hours of that trading day and do what it usually does, is it just kind of sells off for the rest of the day if it's pretty bearish. You can see there's other situations where the gap downs are met with some buying, but a gap up is usually met with some selling. That's traditionally how it's been going with Tesla lately. So if it does kind of gap up tomorrow because of the Chinese market, maybe Chinese market's going to finally respond to the stimulus. I wouldn't be surprised if, let's say, what's a reasonable move on a gap up? Maybe you get 1%, let's say. I think you'd really want to watch the 237 area as a kind of a point of reversal. Just be really careful there. And if you're day trading, maybe consider, entering some type of hedge at this point. Well, maybe that's not really financial advice, but if I was to see pricing quickly run up to the 237 area, I would probably start scaling in some covered calls at this point to prevent too much losses if this was to sell off like it sometimes does. As we can see these examples on gap ups, it sells off. On gaps downs, and when it gaps down, it kind of encounters a little bit of buying. So just something to be really aware of. But so far, in the bearish context of getting out of this wedge, it's kind of following what we thought it would do. We need to see either if tomorrow is a flat open, if tomorrow is a gap down, if there's any buying. If it comes off this wedge, it will fall pretty quickly over the next couple of days. So just kind of be careful of that. And I know that's kind of a bummer to hear. I know no one really wants to keep seeing Tesla go down. But I think it's something we've been talking about happening over and over again. I think we've been anticipating this sell-off to continue. Now, what is a reasonable retracement on Tesla? Let's do a quick fib pull and see to the lows of May. We're actually getting to the point. We're getting to the halfway mark on this fib pull, and what does that really compare to other pullbacks? And we can just do some quick comparisons, and you're seeing how in the spring we're kind of at the area we are now, which is in between the 0.618 and the 0.5 in this area. And so it's possible that you can find support in the near term, hopefully. And so it's definitely going to be coinciding with some type of catalyst or news. What that could be the Chinese market. When it comes to our economic data coming this week, there's really not too much going on there. We do have a lot of retail earnings coming through, like the Targets and the Walmart types. We saw Home Depot do okay, but not too great. And we'll see Target in the morning. So something to keep in mind, kind of the health of the consumer when it comes to buying the necessary staples, or even seeing like the likes of TJ Maxx doing really well tomorrow, which is kind of a discount retailer. Are consumers going to a lower priced product to get the things that they need? It's going to be a real telltale sign of how the economy actually is doing. What about some other pullbacks, corrections that we can kind of see if we can find some maybe some patterns as far as how Tesla likes to retrace a strong move. Some of these peaks are seeing pretty strong retracements actually. Nothing close to the 0.5, actually dropping all the way almost to the 2.216. How about this peak? Let's say this is the high. The low is from many months before. That's 47%. Okay, so let's just do a pull and see where. Okay, So if I was to do a pull from all-time high to the lows in August of 21, kind of this is what I would say is kind of a consolidation or a bottoming before a really big move. That kind of was, I understand it was many months, but this kind of correction is basically kind of in the same spot that we are now between the 0.618 and the half. So maybe when it comes to Tesla's price action, where we could be kind of at the bottom, a near-term bottom, if we look at similar price action from Tesla's historical performance. But we've also seen, of course, some pretty deep corrections throughout Tesla's history as well. So we have to be on our toes as far as how it's going to work tomorrow. If you are like me, you've been in covered calls for a couple weeks now. I would really, you have to kind of watch these covered calls. You kind of have to treat them like they're day trades, or at least if they're long dated, you just kind of take a look at how they're performing. If you are up 70-80% on them, as far as the premium that has been eroded through theta and just the price dropping over the past couple of weeks, you might want to start considering taking a little bit of profit on these cover calls. Number one, to reduce risk to the upside, of course. I know we talked pretty bearishly, but at the end of the day, a hedge isn't just meant to be held until it's expired, right? Like to reduce when the share price is falling, and you have a hedge on, be it put, be it cover calls, like you eventually have to close those positions out, right? And you have to come up with a strategy to scale out of your hedge. And we've had a 20% drop already, right? Let's just do a quick reminder of how much share price has dropped over the course of the last couple of weeks. We're at 22.5% if you include the after hours action. It might be time if you have the ability, if you have multiple puts and calls that are out there, maybe it's time to start considering pulling that in a little bit. Closing that out a little bit so you can take profit and realize the hedge that you put into place. Especially if they're long dated, right? Like if your options are expiring at the end of September or something like that, and what happens if Tesla runs up, you would have kind of lost out on all of those gains from your hedges. I'm not saying, and I don't want you to be completely unhedged. I think it's just that it's been 22.5%. I know that Tesla can correct in the range of like what we've looked at some corrections like 30-40% as well. So I'm not saying not to go. I'm not saying to be completely hedgeless, but you need to start realizing a profit on some of these hedges, and maybe tomorrow's price action will be helpful for you to make that decision. What did we talk about again? Like we're talking about anywhere from filling this gap at around 221, or maybe you can see some support in this range over at 225. But if it's red again tomorrow, let's just kind of consider hedges are great and all, but we don't want them to go worthless necessarily if they're puts, especially. Okay, so I think that's pretty much it. I would say just a kind of a word of warning. I know like we want to watch the Chinese markets tonight to see how it responds to digesting that information, the rate cut, but also there are some precarious stocks that could drag down the indices a little bit. We're seeing Apple kind of straddling this area of around $177 a share. It keeps dipping into it, and I don't know if this is going to be your typical, like reaccumulation, and this is your wick off that's going to, see some buying come out of this. We've seen every rip kind of sold. We're seeing pretty much lower highs on Apple. We're not seeing any highs being taken out decisively. We're not necessarily seeing new lows. We're actually seeing a higher low from today. So, but if this was to fall through, just know that this could be really detrimental to the entire stock market. Apple is such a high weighting, and if Apple was to go down, if Nvidia was to go down, it could be rather problematic. We know Nvidia is not reporting its earnings until next week, so Nvidia might just kind of range for the next couple of days. And as people position themselves in this stock and note that a lot of analysts are still upgrading Nvidia, and they're maintaining buys or overweights on the stock, but not so much Apple. So just be careful there. And tomorrow, hopefully, we can see some green. Probably not though. But if we do, we should all be happy, right? Okay. Have a good night, guys. Bye.